Hi, this is Alvin from Dr. Wealth. Today we're going to talk about a very popular topic, which is regarding CPF. So you can actually increase your CPF interest from 2.5% to 3.2% without additional risk. So this is not a gimmick. Listen to what I have to say. So the thing is that we know that interest rate has been rising and the Singapore government bond yields have also been rising. At this point in time, the bond yields are around 3.2%. Whether you're looking for a 2-year bond or a 5-year bond, 10-year bond, or even up to 30-year bond, is around that 3.2%. So the yield curve has sort of like flattened. And later we also see that even the treasury bill, which is less than a year or less, right, 6 months and a year duration or tenure, will also add about 3.2%. So the yield curve is really, really super flat right now. No matter which tenure you choose, it's around that 3.2%. So how do you game this? Is that you know that the CPF interest rate has not increased, and this topic has been deliberated in the parliament as well. But it doesn't seem like there is any chance of seeing that increase, even though the interest rate has been going up in general. But you can actually manufacture your own interest rate in CPF OA by investing into these Singapore government bonds, because you can actually use your excess CPF OA funds to buy these Singapore government bonds. And the good thing is that the guarantor is the same, because it's still the Singapore government, right? And that means that you don't actually increase your risk while you increase your interest rates. So that is for conservative investors who want to increase these rates to fight against, say, the inflation. And why not Singapore savings bond? So some of you might be thinking, why not buy that rather than this Singapore government securities bond or SGS bonds? So understand that for CPF OA, you can't actually use the funds to buy SSB. You can actually buy the SGS bonds. So that is why we are talking about the SGS bonds. Okay, if you are looking for cash investment, then definitely SSB would be a better choice if you ask me, due to that there's no interest rate risk in that sense, because the price don't fluctuate. It always trade at par, and anytime you want to redeem, it's always at par. So that is why I think that for cash, SSB will make sense. But if you want to do it for CPF OA and increase interest rate, then the SGS bonds will be a more appropriate avenue. And some people will say that, oh, but CPF has that compounding effect, which means that the interest that you earn this year would be part of the principal, where you can generate interest in the next year. Okay, so it's interest on interest. Whereas for a bond, the interest is not compounding. If let's say the coupon rate is 3.2%, each year out of $1,000, you only get $32. Okay, so the interest doesn't compound on the previous year's interest. It's a fixed rate from the start to the end. But if you take a look at the calculation, if you even consider a compounding effect of the CPF 2.5% over a span of 10 years, okay, it will have collected about $280.08 in total, based on a $1,000 amount. And if you use this $1,000 amount and invest in an SGS bond at 3.2% over a span of 10 years, even when there's no compounding effect, you will receive a total of $320 interest. So it is still higher, right? Despite the lack of a compounding effect. Okay, because the span, maybe it has to, the span of that tenure needs to be a lot longer for the compounding effect to really take effect. But at this point in time, you can see even for a 10-year period, the SGS bonds has a high enough interest to even be higher than the compounding effect from a CPF OA account. All right, so that is what makes it interesting. But understand that there are costs involved when you buy a SGS bond. Okay, so for example, there's a $2.50 transaction fee when you buy it and you apply for the bonds, and then there's also a $2 per quarter. Every quarter, the CPF IS, the account, will be charged $2. Okay, so if you hold longer, you'll pay more $2, of course, right? So this is a table where I put it up and to show you the cost of owning the bonds for the different tenure. So for a 6 month, you spend about $650 for the entire period, and then for 10-year, you cost you about $82.50. Okay, the good news is that this is fixed. That means that you can put in more capital and you still pay the same fees. And that should be the way, because you do want to clear the minimum cost, right? Because if you do the calculation, if you only invest $1,000, after factoring the cost, you only receive $237.50 after 10 years. If you only invest at $1,000, okay, so it's actually lower than CPF OA. So if you really want to do this, you have to invest more. And I give you the number to at least to cover all the costs and be higher than CPF OA interest is to invest at least $3,000 into these SGS bonds. Of course, the more the merrier, the more you will cover the fixed costs from then on, right? So that is where that sweet spot is. Okay, if you invest less than 3,000, it's not worthwhile to do so because the cost will eat up some of these gains. So that is something to take note of. And where do you buy this, right? So on the MAS website, Monetary Authority of Singapore website, you can go and see the details, right? When is the release date for these bonds? When do you apply for it? And they have different tenures. Okay, so this is what are the upcoming bonds from 2 years tenure and onwards. So the current one that is available right now is a 30-year bond, okay, which the tenure I think is too long, and I'll explain what is a good range to look at later on, right? But at this point in time, that this month, okay, at the point of recording, there isn't any that I think is interesting. But come October, you never know, right? There can be a 2-year or 5-year or a 10-year bond that may be coming up, and interest rate might even be higher than 3.2%. Okay, so now for the SGS bonds is a wait and see. But on the other hand, there's this treasury bill, which is 1 year or less, which is in this case is 6 month and 1 year tenure. Very, very short. Okay, it's also around 3.2%. You can see for 6 months is 3.19% based on 19 September coupon rate, and then 1 year is 3.15%. So it's also around that range, as I told you just now, right? The yield curve has been very flat, so you can consider this if you are interested to yield this higher interest earlier. Okay, so you can look at these treasury bills. So the 1 year treasury bill, you can see that every once a quarter there is a new issue. Right, so the upcoming one is in October, so that is as early as you can apply for it. And then there's a 6 month tenure treasury bill. Every month there are 2 tenders. Okay, there are 2 new issues, so this is not a problem. You get the frequency. But if you ask me, okay, so how do you select this tenure? Okay, so there are a few questions that you need to address, right? Few considerations that you need to think about. The first is that, do you need the CPF OA funds? Okay, so if you need the CPF OA funds to pay for house, to buy your new house, or to pay for education, then this is not a good way to park your cash, extra CPF OA funds into this SGS bonds, because you may need the funds, but you can't. It may not be a good time to sell it, right? To redeem the bond. Okay, it may be trading below the par value. So that is what you don't want to get into, right? So if you really need the funds in the near future, it's better not to invest anything. Okay. The second thing is that if let's say you choose a treasury bill, because the really right now, if you really want to look at some of these SGS bonds or treasury bills, is going to be the 6 month, right? That's the earliest you can get. Otherwise, you wait for the 1 year, which is in October next month. So if you do too short the tenure, you will have more costs, okay? Because if let's say after 6 months your treasury bill mature and you get back the proceeds and you want to buy another treasury bill, right? You incur transaction costs. Okay, 250 per transaction is not a lot, but it still eats up, you see, because every percent counts, right? Every dollar counts. So I would say that maybe going for at least a year makes more sense, right? 6 months sounds a bit shorter, and the rollover cost may be significant, especially if you don't invest a big sum. Okay, and then number 3 is that you would also want to consider, and what is your perception of this interest rate environment in the next 5 years, 10 years, right? Of course, nobody knows because we don't have a crystal ball. But if you are happy with this over 3% interest rate, and you never know, because interest rate may fall in the future, right? It may fall back to say 2% in the next 5 years or so. But if you buy a 10-year bond that is 3.2%, you actually lock in a longer period to ensure that you enjoy this higher interest rate longer than where the interest rate currently is trading, or in the next few years, right? So if you're happy with this rate, you can opt for a longer tenure, right? But I would think that point number 4 is not too long. I think 30 years is too long. 25 years sounds a bit too long as well, because some of you maybe is nearing the retirement age, and you might need the funds for your living expenses. So there is some planning consideration that you want to take into when you consider the tenure, right? So these are the considerations. So each, its own. You never know what situation you are. So please, there is no one size that fit all when it comes to selecting the tenure. And I want to give you a few more tips if you really want to do this SGS bond investment. So the tip number 1 is, don't invest all your CPF OA as the first 20,000 attract the 3.5% interest, okay, because you know that there is a bonus additional 1% for the first $20,000 in your OA, and that is still higher than your SGS bonds, okay. So don't invest everything, right? You should have that first $20,000 inside. And tip number 2 is that don't use your CPF special account to do it, because your CPF special account is still at 4% yield, higher than at 3.2% currently, until the day that we really see that the Singapore government bond yield goes way above 4%, right? Then we may come and talk about how to maximize your CPF SA interest. But at this point in time, it's a no-go, okay, because the CPF SA is still yielding higher than the Singapore government bonds. And tip number 3 is that don't buy the SGS bond from the secondary market, because these bonds, although are traded on the SGX, you can buy and sell them like stocks. It is not advisable to do so, because these bond prices will move. Okay, will move up and down, right? With respect to the interest rate environment. And if it goes up, it's fine, right? Because you can make some capital gain out of it. But if it goes down, by selling it means that you would have incur some losses, okay? And even for buying and selling, the transaction cost is much higher because of the brokerage fee that will be levied on it. So it might not be worthwhile for you to do so. And not forgetting that it's a spread. That means the bid-ask price differences. Okay, so if the spread is too wide, you will incur further losses in that sense. Okay, so this is something that I think is not worth the risk, right? It's better that you get it at the issue, right? Get it at the par value, and then you hold it until maturity. Tip number 4, don't sell your SGS bonds before maturity, so as to avoid the chance of selling below the par value, right? So this is the point that I actually talked about previously, okay? So I jumped the gun a little bit. So as I said, the prices will fluctuate as the bonds get traded on the exchange, so don't sell, really hold until maturity. That's why I talk about the tenure is very important. You must be comfortable holding until maturity. Tip number 5 is don't buy with all your CPF OA excess funds, right? Because maybe you think that, oh, 3+%, yeah, no brainer, I should just max out everything. The thing is that, of course, it also depends on how you view the interest rate environment. My view is that I do think that the interest rate is likely to go up even further, right? Maybe, a few months down the road, we can see a 3.5% from the Singapore government bonds. So if you run out of bullets, then you might miss the opportunity to buy, right? So maybe buy a tranche first, and then as the rates go up, you can lock in at the higher rates, okay? Because as we speak, the US interest rate is still going up, and Singapore being a country that don't set interest rate, we set exchange rate, it is very likely that we inherit some of this interest rate increase from the US as well. So that is why I do think that the interest rate is likely to go up and to come down in the meantime. All right, so how do you apply? Unfortunately, you can't do it over the internet banking. Okay, if you are using cash, you can, but if you are using CPF OA to buy these bonds, you can't. You have to personally go down to the branch, the bank branches to apply for it. Okay, so and only the local 3 banks who are the dealers for this CPF IS scheme, you are able to do it. Okay, you cannot do it in any other banks. So that will be the 3 local banks: DBS, OCBC, and UOB. And you must also open a CPF IS account, right? Because it is they will custodize it under that, and that's where the fees go to, right? It goes to the banks. Okay. And so in summary, I hope you understand where I'm coming from, right? Because we know that CPF OA rates have not increased despite the interest rate has been rising, but that is not a showstopper, because you can actually do it, manage this actively by investing your CPF OA excess funds into these SGS bonds that is yielding currently 3.2%. So the guarantor is still the same. You don't incur additional risk by getting higher returns. So that is a good way, or even conservative investors to think about. So I hope this has been informative for you, and let me know what's your thoughts in the comments. And hopefully you will join our channel, right? Subscribe to our channel, like this video, and I'll see you around. Goodbye.